So housing markets in the Southeast and the West are seeing more inventory and softer demand.
California's housing market is frozen. The statewide median price sits just shy of $900,000, one of the highest in the nation. But mortgage rates now top 6.5%, double what most owners locked in just a few years ago. For a typical borrower, swapping to today's rates adds $675 per month. In San Francisco, the penalty is $915. New listings have plunged, down more than 17% in San Francisco alone. Buyers, sellers, and renters all face the same reality. California housing is stuck. California's housing market didn't freeze overnight. It's the outcome of a boom and bust cycle colliding with long-standing structural flaws. The national market surged after the pandemic. The Federal Reserve slashed borrowing costs to near zero. Buyers rushed in. Owners refinanced. Across California, households locked in mortgages below 4%. According to the Federal Housing Finance Agency, demand spiked, prices soared, and by 2022, California homes were already among the most expensive in the country. Then the pendulum swung. Facing rapid inflation, the Fed reversed course. Interest rates jumped from near zero to more than 6.5% in just 2 years. That swing turned the market upside down. Buyers suddenly faced monthly payments hundreds of dollars higher than just months earlier. Sellers realized listing a home meant giving up their golden rate mortgages. Both sides pulled back. The data shows the freeze. In San Francisco, new listings fell more than 17% year over year. Double-digit declines hit San Diego, Riverside, and Anaheim as well. Of the 10 U.S. metros where new listings fell fastest, 5 were in California. Inventory vanished. Not because people didn't want to move, but because the math of moving no longer made sense. Agents on the ground confirm the slowdown. The number of transactions have absolutely slowed down, said one Bay Area realtor. Higher borrowing costs and record prices created what she called really, really low affordability. Economists call it the lock-in effect. If most owners hold mortgages below 4%, while new buyers face rates over 6.5%, selling becomes irrational. The Federal Housing Finance Agency calculated the difference. Nationwide, swapping to a new mortgage adds about $398 per month. In California, where the median sales price is nearly $900,000, the monthly penalty jumps to $675. In San Francisco, it's $915. For most families, that cost alone is reason not to sell. This lock-in feeds a cycle. Fewer owners list. Buyers have fewer options. Prices remain elevated despite weak demand. Frustrated would-be buyers spill into the rental market, raising rents and squeezing affordability even further. The market slows not just in sales, but across the housing system. California adds its own layers of dysfunction. Proposition 13, passed in 1978, ties property taxes to the purchase price, allowing only small annual increases. Long-term owners now pay far less than new buyers. A study by the Lincoln Institute of Land Policy found that in cities like Los Angeles, San Diego, Oakland, and Sacramento, new buyers pay more than twice as much in property taxes compared to long-time homeowners. That tax gap locks people in place even further. So the setup is this: prices near record highs, mortgage rates at multi-decade peaks, property tax rules discouraging mobility, and listings evaporating. In this environment, aspiring buyers can't find homes, owners won't sell, and developers face a decade-long drought in new supply. The result is exactly what economists describe: a market stuck in molasses, slower sales, stagnant listings, and more deals cancelled at the last minute. For California, the drought is deeper than the national average. The boom is over. The freeze is here. The question isn't just how many homes sell, it's who is still buying and why. In California's frozen housing market, the pool of active buyers is narrower than ever. For most households, affordability is the wall. Realtors report demand has absolutely slowed down because borrowing costs and prices together are really low in affordability. The median home hovers around $900,000 at mortgage rates above 6.5%. Payments consume far more than the typical household can sustain. For families without cash reserves, ownership is off the table. Instead, the remaining buyers are concentrated. High-income dual-earner households, particularly in tech, healthcare, and finance, still have the income to qualify. Cash buyers and investors remain, especially in coastal metros like San Francisco and San Diego. For them, the lock-in effect isn't relevant. They are less sensitive to rates, more focused on long-term asset value. But these buyers are the minority. Redfin's chief economist notes that nationwide, the mortgage lock-in has widened the gap between what current owners pay and what new buyers face. In California, the difference is even steeper. For an owner who refinanced below 4% in 2020, selling today and rebuying means taking on a loan at more than 6.5%. That translates to $675 more per month statewide, or $915 more in San Francisco. Very few are willing or able to take that leap. The freeze forces would-be buyers into the rental market. With listings drying up, down 17% in San Francisco, and double-digit declines across San Diego, Riverside, and Anaheim, renters face added pressure. Families that would have purchased are pushed back into apartments or rental homes, driving up demand and keeping rental prices elevated. The housing squeeze shifts from sales to leases. Investors read this demand as opportunity. Some focus on rentals, betting that persistent ownership barriers will keep tenants locked in for years. But the investor share is limited by the same factors: high prices and tight lending. Only the most capitalized investors stay active. First-time buyers, once the lifeblood of market growth, are largely absent. Between mortgage lock-ins, property tax disparities under Proposition 13, and stagnant wages, they cannot compete. Even FHA and VA loan holders, who often enter with smaller down payments, face daunting monthly costs, so the anatomy of demand in 2025 is clear. Cash buyers and high-income households remain at the top. Investors circle niches, but for the majority of Californians, the door is shut. The effect cascades. Sellers stay put, buyers wait, and renters absorb the overflow. A market driven by the few leaves, the many locked out. The slowdown in California housing isn't only about rates and prices. There's a quieter crisis that stalls deals at the closing table: insurance. When buyers sign a purchase agreement, they assume the loan will be funded, but lenders won't close without proof of coverage. In California, wildfire and flood exposure make that proof harder to secure. As insurers exit markets or cap new policies, transactions collapse at the last minute. The Cal Matters report highlights an uptick in deals cancelled at the last minute as part of the market freeze. This hidden pressure acts like a stealth affordability shock. Even where mortgage math works, premiums tip the balance. A household qualifying for a $900,000 home with a 6.5% loan still faces rising insurance costs. In risk-prone counties, annual premiums climb into the thousands. Stacked on top of already stretched monthly budgets, the added cost is enough to derail closings. Realtors in San Francisco and Riverside describe clients pulling out not because of the list price, but because coverage was either too expensive or outright unavailable. Sellers, facing these late cancellations, withdraw listings rather than chase fragile buyers. This compounds the listing drought already visible in the data. New listings down more than 17% in San Francisco, with double-digit drops across San Diego, Riverside, and Anaheim. The result is a vicious cycle. Higher premiums shrink the buyer pool. Shrinking demand discourages sellers from entering the market. Fewer listings mean fewer transactions. More deals collapse mid-process, undermining confidence. Even households willing to stretch for a mortgage balk when the final insurance quote arrives. Economists emphasize that this uncertainty is as damaging as the costs themselves. Buyers hesitate to commit when they can't predict what the total monthly outlay will be. The report calls the statewide market stuck in molasses, and insurance is part of the glue. The cancellations also shape geography. High-risk zones, foothills, fire corridors, floodplains suffer the highest fallout rates. In these areas, properties linger, prices stagnate, and buyers wait. By contrast, lower-risk neighborhoods with stable coverage see more consistent closings, even if volumes are muted. For policymakers, this is a growing concern. State efforts to stabilize insurance markets run headfirst into the financial reality. Coverage is expensive, and without it, deals don't close. For households, the takeaway is brutal. Securing a loan approval is no longer enough. Without affordable coverage, the transaction is dead. By 2025, California's insurance problem has become a housing problem. Mortgage rates and lock-in math keep most people from listing. For those who do, insurance determines whether the sale completes. The freeze is not just in rates or property taxes, it's in the underwriting offices of insurers. That fragility ensures that even modest improvements in affordability cannot thaw the market. Affordability is the hinge of California's housing freeze. Even with inventory shortfalls and insurance complications, the real barrier is the math. For most households, moving simply doesn't pencil out. The Federal Housing Finance Agency analyzed the lock-in effect. By mid-2024, the majority of U.S. mortgage holders had rates below 4%. Compare that to a new loan in 2025, where the average rate is more than 6.5%. That gap changes everything. For the average borrower nationwide, swapping to today's higher rate would add about $398 per month. In California, the cost is steeper because home values are higher. The FHFA found that a typical California borrower would pay $675 more per month if they replaced their existing mortgage. In San Francisco, the penalty is extreme, $915 more per month. That alone explains the freeze. A family sitting on a $3,000 monthly mortgage would face nearly $4,000 under new terms. Few households willingly add a car payment's worth of expense just to trade homes. The logic is simple. Better to stay put. Then there's property tax. Proposition 13, passed in 1978, ties tax assessments to the purchase price and caps increases at a modest rate. Over decades, long-term homeowners pay far less than newcomers. A Lincoln Institute study found that in Los Angeles, San Diego, Long Beach, Oakland, and Sacramento, new buyers pay more than twice as much in property taxes compared to similar long-time owners. For example, a family that bought in 1995 pays taxes on an assessed value far below today's median, near $900,000. If they sell and rebuy, their tax base resets. That could mean an annual jump of several $1,000s on top of higher mortgage payments. Economists call this the tax lock-in. It's as powerful as the mortgage lock-in. Stack these costs together. Mortgage lock-in $675 statewide, $915 in San Francisco. Property tax reset, doubling annual bills for new buyers. Insurance premiums, often hundreds per month higher in high-risk areas. HOA dues and assessments, add another $200–400 in many markets. The combined monthly penalty of moving easily tops $1,000–1,500. For most households, the financial incentive is clear. Don't move. That explains why new listings plunged by double digits in every major California metro and by 17% in San Francisco. Homeowners have rational reasons to hunker down. Buyers have fewer options. Prices stay high. And renters absorb the spillover demand. The affordability math locks the system in place. Californians aren't staying put out of comfort. They're staying put because selling means surrendering cheap mortgages and tax protections for higher bills across the board. In this calculus, freezing feels rational. Liquidity is the lifeblood of real estate. Homes must move from listing to offer to close for the system to function. In California, that chain is breaking. The Cal Matters report describes the housing market as stuck in molasses. High interest rates and high prices have stalled buyers. Sellers, unwilling to give up their low mortgage rates, keep their homes off the market. The result, stagnant sales volumes, plunging new listings, and contracts collapsing before completion. San Francisco saw new listings fall by more than 17% year over year. San Diego, Riverside, and Anaheim recorded double-digit drops as well. 5 of the 10 U.S. metros with the steepest declines in new listings were in California. This collapse in supply means liquidity is already thin before a buyer even enters the picture. For those who do try to transact, the odds of success are falling. Realtors report an uptick in deals cancelled at the last minute. That means more escrows collapse before close. Sometimes it's insurance. Sometimes financing falls through when underwriting tightens. Other times, buyers simply balk at the final math of mortgage plus taxes plus insurance. This rise in failed closings makes sellers cautious. Instead of listening at all, they sit on the sidelines. Why risk a failed transaction when staying put guarantees stability? Each cancelled deal ripples outward, discouraging new listings and draining liquidity further. Economists explain this as a feedback loop. With fewer listings, buyers have less to choose from. With less inventory, competition stays tight, keeping prices high despite weak demand. Yet high prices and high borrowing costs suppress affordability, leading to more cancellations. The loop continues. Thin supply, fragile demand, and fewer completed sales. California's frozen market stands out compared to the national slowdown. Nationwide, sales have slowed. But California layers on Prop 13's tax lock-in and sky-high property values. The Federal Housing Finance Agency found that replacing an old mortgage with a new one costs Californians $675 more per month on average and $915 more in San Francisco. That cost is unique to California's price levels and explains why liquidity is weaker here than elsewhere. Liquidity also shows up in days on market. While the report doesn't provide exact DOM figures, agents describe properties lingering longer, especially in high-risk or high-cost areas. Sellers adjust expectations. Buyers hesitate. Instead of brisk turnover, transactions drag or dissolve. The outcome is a market where the pipeline clogs. New listings collapse. Pending sales stall. Cancellations rise. The flow of homes through the system slows to a trickle. For buyers, that means frustration. For sellers, it means risk. And for California as a whole, it means a housing market that looks less like an engine and more like quicksand. California's housing market doesn't just move slowly, it stops suddenly when shocks hit. With affordability stretched and liquidity fragile, even small jolts can freeze activity across entire regions. The Federal Reserve's interest rate path is the first trigger. Over the past 3 years, the Fed swung from near-zero rates to more than 6.5%. Each hike rippled instantly into mortgage markets. For buyers on the edge of qualifying, one rate bump erased affordability overnight. Escrows fell apart. Sellers withdrew listings. Confidence stalled. The whiplash effect shows how vulnerable California housing is to policy shocks. Global trade tensions are another wild card. The CalMatters analysis warns that tariffs could weigh on economic growth. In a state as globally connected as California, home to ports in Los Angeles, Long Beach, and Oakland, any slowdown in trade activity ripples into jobs, wages, and housing demand. When employers freeze hiring, buyers freeze too. Inflation is a third trigger. At 3% nationwide, it erodes purchasing power just enough to matter. Families recalculating budgets decide against stretching for a $900,000 home when groceries, gas, and insurance all cost more. Inflation also keeps the Fed cautious. If prices flare, another rate hike could arrive, shocking affordability again. Then there's the stock market. The report points to fears of a potential bubble. For California's wealthier buyers, stock portfolios are a primary source of down payment funds. A sudden market correction can erase hundreds of thousands of dollars overnight. When equity wealth evaporates, luxury buyers retreat, escrow accounts dry up, and coastal metros lose liquidity in days. Environmental shocks compound the fragility. Wildfires and floods redraw hazard maps, forcing insurers to retreat. As noted earlier, lenders won't close loans without coverage. In fire-prone corridors, one blaze is enough to halt transactions across entire zip codes. Families in escrow scramble, deals collapse, and markets freeze in real time. Each of these triggers, rates, tariffs, inflation, equities, wildfires, lands on a market already slowed by the lock-in effect and Prop 13 tax distortions. That's why economists describe California housing as uniquely fragile. Unlike other states, where affordability challenges are steep but not crippling, California buyers face the dual penalty of high prices and volatile shocks. The outcome is not gradual decline, but sudden paralysis. A single Fed meeting, a tariff announcement, a wildfire. Each can stop transactions midstream. And when confidence collapses, it takes months to restart momentum. For 2025 and 2026, this fragility is the defining risk. California housing doesn't just freeze in molasses, it ices over at the first sign of trouble. Policy is as powerful as prices in shaping California's housing freeze. If mortgage math keeps people from selling, tax rules and political fights keep them from moving. Start with Proposition 13. Passed in 1978, it caps annual property tax increases and ties assessments to purchase price. That means long-time homeowners pay far less in property taxes than new buyers. A Lincoln Institute study found that in Los Angeles, San Diego, Long Beach, Oakland, and Sacramento, new buyers pay more than twice as much in property taxes as their long-term neighbors. This tax lock-in discourages turnover. An owner who bought in the 1990s might pay property taxes on an assessed value a fraction of today's near $900,000 median. Selling and rebuying resets the tax base, doubling or tripling annual payments. For many, that makes moving financially irrational, even if they want more space, better schools, or a shorter commute. State lawmakers have tried to chip away at the freeze with construction incentives, but new housing laws often collide with local zoning resistance. Coastal cities restrict density. Inland counties push for expansion. The result is patchwork progress. Even as Sacramento pushes for more units, cities drag their feet. The Cal Matters report highlights skepticism that even laws aimed at boosting new construction will make much of a dent in the frozen market. Lenders and insurers add another layer of friction. Without proof of insurance, loans won't close. But state regulators face pressure to stabilize coverage markets after insurers withdraw from fire and flood-prone zones. The uncertainty slows transactions even when demand exists. Together, these forces, tax policy, state-local clashes, and regulatory gaps, create a housing system that resists change. Homeowners stay put, not just because they want to, but because policy rewards immobility. Buyers are penalized twice, once in the mortgage rate and again in the property tax reset. Economists describe it as inertia by design. Prop 13 locks down tax bills. Cities resist density. State policy collides with local politics, and every attempt to fix affordability stalls in bureaucracy. The result is that California's market remains frozen, with mobility more restricted here than almost anywhere else in the country. For households, the message is blunt. Policy makes staying put the smartest option. Until the tax code changes or local governments embrace real reform, the freeze will remain. California isn't one market. It's a patchwork of metro areas, each frozen in its own way. The numbers show who is suffering most and where faint resilience remains. San Francisco stands out as one of the hardest hit. New listings fell by more than 17% year over year. Affordability is crushed by both high prices and steep monthly penalties. For a median-priced home here, replacing an old mortgage with a new one means paying $950 more per month. Sellers stay put. Buyers hesitate. The city epitomizes the lock-in freeze. Los Angeles mirrors this trend. Prices remain near the state median of $900,000, but local wages don't keep up. Long-time owners benefit from Prop 13's tax breaks, but newcomers face double or triple the annual property tax bill. Inventory is thin. Deals are rare. Renters feel the spillover as families locked out of ownership flood the leasing market. San Diego is another high-stress zone. Listings fell by double digits, one of the steepest drops in the country. Like San Francisco and Los Angeles, San Diego combines high property values with insurance risk from wildfire corridors. That makes buyers even more cautious. Realtors describe sales as absolutely slowed down because affordability here is really low. Riverside offers a partial contrast. Listings are down, but not as severely as coastal metros. As an inland market, Riverside draws buyers priced out of Los Angeles. Relative affordability, homes well below San Francisco levels, provides some cushion. Still, borrowing at more than 6.5% limits how far that cushion stretches. Sacramento shows similar dynamics. It absorbs out-migration from the Bay Area, but affordability remains strained. Long-term owners cling to Prop 13 protections, while new buyers pay more than twice the property taxes of their neighbors. Demand is muted, but relative prices give Sacramento slightly more breathing room than the coast. Anaheim rounds out the metro ladder. New listings dropped by double digits, placing it alongside San Diego and Riverside in the national top tier for fastest declines. The theme repeats: owners locked in by mortgage and tax math, buyers locked out by costs. The hierarchy is clear. Most stressed, San Francisco, Los Angeles, San Diego. Moderately stressed. Anaheim, Sacramento. Slightly more resilient. Riverside. Yet all metros share the same diagnosis. Prices stay high. New listings plunge. Buyers hesitate. Sellers stay put. The local details differ, but the statewide freeze binds them all. California's housing market is frozen, and the reasons run deep. Mortgage math, property tax rules, insurance shocks, and stalled policies all converge to make staying put the logical choice. The numbers tell the story. The statewide median home hovers near $900,000. Mortgage rates above 6.5% mean most owners would pay $675 more per month to move. In San Francisco, the penalty is $915. New listings have plunged, down more than 17% in San Francisco, with double-digit drops in San Diego, Riverside, and Anaheim. Property taxes double or triple for new buyers under Prop 13. And deals are collapsing at the last minute, leaving the market stuck in molasses. For buyers, the checklist is clear. Run full cost math, mortgage, insurance, taxes, HOA, before committing. Verify insurance early. Closings fail when coverage disappears. Track local inventory trends. Supply is uneven across metros. Expect competition in rentals as more families are locked out of ownership. Factor in long-term risks, Fed rate swings, tariffs, and equity volatility. For sellers, patience is the rational choice. Giving up a 3% mortgage for one above 6.5% makes little sense. Property tax resets only add to the penalty. Until policies change, immobility remains the default. The recap is stark. Median near $900K, rates above 6.5%, $675 per month statewide, $915 in San Francisco, listings down 17% or more, cancellations rising, property taxes doubling for new buyers. Together, they explain why California's housing market is frozen and why so many reasons to stay put outweigh the impulse to move.